Welcome back to Talk Tickers.
Good to be here.
Yeah, so this is the deep dive where we don't just read the headlines for you.
Right, definitely on.
We rip open the hood, check the oil, and figure out what the engine is actually doing.
Because the surface level doesn't cut it anymore.
Exactly. We are the professional earnings call summarization deep dive for the serious market watcher. I am your host, ready to get into the weeds today.
And I am here to make sure we don't, get completely lost in them.
It's good to have you back at the desk.
Always a pleasure.
So today we are turning our attention to the grocery aisle.
The most brutal aisle in retail.
Seriously, but specifically we're looking at the healthy, crunchy, organic aisle today.
The high margin aisle.
Right. We are talking about Sprouts Farmers Market.
Ticker symbol SFM.
SFM, exactly. This is their Q4 and full year 2025 earnings deep dive. And just looking at the notes we have here, the theme seems to be, well, it feels like a bit of a hangover after a really massive party.
That is honestly the perfect way to frame it. I mean, this print was a fascinating study in market psychology.
Yeah.
Oh, absolutely. If you want a textbook definition of a beaten lower, This is it.
The classic beaten lower.
Right. The quarter they just finished. Solid. Great, even. The quarter they are about to walk into.
Not so much.
Not so much at all.
Yeah, let's set the vibe immediately for everyone listening. The market reaction to this print was, let's just call it a cold shoulder.
Very frosty.
We saw the stock drop about 80 basis points. That's roughly negative 0.81%.
In the after-hours session.
Right, in the after-hours session immediately following the print. So it wasn't a crash.
Yeah, no panic selling.
Right, it wasn't a bloodbath. It was just this heavy collective sigh from investors.
Exactly. It was the market looking at the scoreboard for 2025, nodding approvingly at the great numbers, and then
looking at the guidance.
Yeah, looking at the guidance for the start of 2026 and just feeling a little bit queasy.
The street narrative shifted instantly on this one.
It did. You had analysts scrambling.
You had UBS cutting their price target to neutral, Wells Fargo cutting to overweight.
Because the growth story just hit a very specific speed bump.
So here is the roadmap for today's deep dive. We've got a lot of ground to cover for you. First, we are going to do the snapshot.
Just the headline numbers you need to know from Q4.
Yeah, exactly. Then we are going into the operational autopsy.
The fun stuff.
The really fun stuff. Why is Q1 2026 going to be negative? Why are customers leaving?
Yep.
Then we're going to pivot to the new buzzword, which is affordability.
Everyone's favorite word right now.
Right, and what that actually means for their margins. And finally, you definitely want to stick around for the This Is Not Financial Advice segment.
We have a really good one today.
We do. We're pitching a trade involving the no seed oil revolution.
You are not going to want to miss that.
Okay, let's start with the snapshot. Q4 2025. What did the scoreboard actually say? Because, look, on the surface, it didn't look like a disaster at all.
No, not at all. On the surface, it looked pretty good. Earnings per share, EPS, came in at 92 cents.
Okay, 92 cents.
Now, to put that in perspective for you, the street consensus, what all the big banks thought was going to happen, was sitting at 88 cents.
So that's a beat.
It is a beat. They beat expectations by roughly 4.5%.
Which is solid.
Right. In this specific environment where retail is getting hammered left and right by the consumer pulling back, a beat is a beat. You take it.
And what about the top line? Revenue?
Revenue came in at $2.149 billion.
Okay.
That is up 8% year over year.
8%.
Yeah, and that was basically right in line with expectations. No big surprise there.
Just steady, predictable growth.
Exactly. They moved the volume they told everyone they were going to move.
Okay, but what about the comps? Same store sales. Because that is the absolute heartbeat of any retail operation.
It is the only metric that really matters at the end of the day.
Right. You can open new stores all day long to pad your revenue, but are the existing stores actually growing?
So comps were positive 1.6% for the quarter.
Positive 1.6.
No, pause right there. That is positive growth, which is good. You never want to see a negative sign in front of that number.
Sure.
But if you look at the trend line over the last 4 quarters, it is visibly slowing down.
It's decelerating.
Right. We aren't seeing those massive mid and single digit jumps we saw earlier in the cycle. It is cooling off.
It's kind of like a runner who is still moving forward, right?
Yeah.
But they've stopped sprinting and now they're just settling into a slow jog.
That's a great way to put it.
And what about margins? Did they hold the line on profitability while this was happening?
Gross margin sat at 38.0%.
Okay, 38 flat.
That is down about 10 basis points year over year.
10 basis points? That's tiny.
The tiny compression, yeah. It's
Yeah.
essentially flat. We will get into exactly why that matters later, specifically regarding the shrink issue and their new loyalty program.
Right.
But holding a 38% gross margin in the grocery sector is still incredibly impressive.
People forget that.
They do. Remember, typical grocery margins are razor thin. Kroger operates significantly lower than that.
Sprouts is maintaining that premium tier pricing.
Exactly. So if you just look at Q4 in a vacuum, you would say, great job, Sprouts.
But we don't live in a vacuum. We have to talk about the full year context.
We do.
Because 2025, the year they just wrapped up, it was a monster year, wasn't it?
It was what we call a hero year.
A hero year.
You really have to understand this context to understand the pain that is coming in the guidance.
Wait it out.
Full year earnings growth for 2025 was over 40%.
40% EPS growth for a grocery store. That is absurd.
It's insane. And comp sales for the full year were up over 7%. They were firing on every single cylinder imaginable.
Which brings us to the ouch moment.
The guidance.
The guidance. Because when you have a hero year, you eventually have to lap it.
That's the problem.
You have to beat your own record, and gravity always wins eventually.
Management came out on a call and gave the outlook for Q1 2026. And they expect comparable store sales to be negative.
It's negative.
Specifically, -3% to -1%.
Wow, that is a hard pivot.
Whiplash.
You go from up 7% for the year to guiding -3% to start the next year.
Yeah.
That is exactly what spooked the market. That's not a tap on the brakes. That is slamming both feet on the brake pedal.
And the full year outlook for 2026 isn't exactly a rocket ship either. EPS guidance is slated at $5.28 to $5.44.
Okay.
Now, there is a nuance here that serious investors really need to catch.
The calendar thing.
Right. 2026 is a 53-week year.
Let's explain that. Retailers usually operate on a strict 52-week calendar for reporting.
Correct.
But every few years, the math catches up with the actual calendar, and you get a 53rd week thrown into the fiscal year.
Exactly. And that extra week adds about 21 cents to the EPS.
Just purely because the stores are physically open and selling groceries for 7 more days.
Purely because of time. So if you strip that 21 cents out to compare apples to apples with 2025, the core growth looks even flatter.
It's almost non-existent.
Right. So the market looked past the nice Q4 beat, ignored it completely, and stared directly at that negative comp guide for Q1.
So let's do the deep dive into that. Let's get into the why.
Let's do it.
Why is traffic slowing so abruptly? Why are they projecting negative comps? Because management was pretty candid on the call.
Surprisingly candid.
They said they were not happy with how the year finished. It is rare to hear a CEO be that blunt about disappointment during a quarter where they actually beat consensus.
They were very direct. They said the slowdown is being driven by what they're calling low-engaged customers.
Low engaged. That sounds like corporate code.
It is.
Who are these people exactly?
These are the tourists.
The tourists.
The people who aren't the diehards. I only eat organic kale and grass-fed elk. Daily shoppers.
Right.
These are people who popped in during 2025 because of a specific viral item on social media, or maybe a specific targeted deal.
So we're talking about the TikTok shoppers.
Exactly. Management specifically mentioned their viral success with things like eggs last year.
Oh, I remember that.
Remember when conventional egg prices went absolutely crazy due to avian flu?
Yes, standard eggs were like $8 a carton at regular stores.
Right, and everyone was looking for alternatives. So they went to Sprouts.
Or the cottage cheese trend.
Yes, the cottage cheese craze. People came in to buy the viral eggs or the viral cottage cheese. They looked around, maybe bought a few other things to fill the basket.
And that boosted the 2025 numbers.
Hugely.
Yeah.
But now they are visiting less.
The trend died down.
And when they do visit, they are putting fewer items in the basket. They grab the one thing they need and leave.
So the tourist shopper has essentially left the building.
Or at least they aren't buying the expensive souvenirs anymore. They came for the show, saw it, and went back to their regular, cheaper grocery store.
Right.
And there's another massive factor in this, which we call the lapping effect.
Okay, break that down.
You have to remember what happened in Q1 of 2025. It was a monster quarter, double-digit comps.
Which is unheard of.
Right. And why did that happen? Partly because of a massive strike at King Soopers.
Oh, right. The competitor strike in Colorado. That is a huge external variable that you can't control.
When your main competitor, and in that region, King Soopers, is the 800-pound gorilla when they are closed or have a giant picket line in front of the doors, you get a lot of free Unearned traffic.
People still need to buy milk for their kids.
Exactly. If they can't or won't cross the picket line, they come to you. Sprouts enjoyed a massive temporary boost from that last year.
And that is obviously not repeating this year.
No.
No.
So strictly from a mathematical perspective, you are comparing a normal baseline quarter, which is Q1 2026, against a quarter that was basically on steroids.
Q1 2025.
Right. That is why the math looks so ugly right now.
That makes total sense. It's like trying to beat your personal best marathon time, but your personal best was set while you were running downhill with a huge tailwind.
That's a perfect analogy. And now Sprouts is running on flat ground into a headwind.
Yeah.
The low-engaged customer is gone, the strike benefits are gone, and now they just have to stand on their own 2 feet.
Let's talk about the margin squeeze then, because we mentioned gross margins were down a tick, about 10 basis points.
Right.
But there is a much bigger story here regarding expenses. It is not just about what they sell the avocados for, but what it costs to actually run the shop.
There's a big story there. Management flagged something called fixed cost deleverage.
Oh, okay.
They expect 85 basis points of EBIT margin pressure coming right at them in Q1.
Okay, I want to pause here for a second. Fixed cost deleverage.
It's a mouthful.
It is a term that gets thrown around on financial networks all day long, but let's actually unpack it for you listening right now. What is physically happening inside the store to cause this?
Think about the physical grocery store. You have to pay the rent.
Right.
That check is exactly the same every single month. You have to pay the electric bill to keep the massive freezers running.
Those commercial freezers aren't cheap.
Not at all. And you have to pay the staff to mop the floors and stock the shelves. Those are your fixed costs.
Okay.
They do not change much whether you have 100 customers walking through the door or 1,000 customers walking through the door.
The lights cost the exact same amount to keep on whether someone actually buys the milk or just looks at it.
Exactly. So when your comps are positive, when your sales are going up, you cover those fixed costs easily. And all that extra profit just flows beautifully to the bottom line.
That's what we call leverage.
That is leverage. You are leveraging your fixed asset base to make more money. But when comps go negative, when your sales drop, you still have to pay the same rent and the same electric bill.
But you have fewer dollars coming in the register to cover it.
Right. So that eats into your profit margin very rapidly. That is deleverage.
So because sales are dipping slightly, the underlying cost of just keeping the doors open becomes a much heavier burden relative to the revenue they're pulling in.
Precisely. It is a nasty double whammy. Lower total sales and lower efficiency on the profit from the sales you do make.
And on top of that, they have a self-inflicted cost-hurting margins right now. The loyalty program.
Yes.
But wait, isn't a loyalty program generally a good thing? Every major retailer has one. It keeps people coming back.
Long term, yes, absolutely. Short term, it is incredibly expensive to launch.
Because of the promos?
Think about it from the consumer side. When you sign up for a new grocery app, what do you immediately do?
You redeem the free points. You get the free stuff.
You use the $5 off coupon. That hits the gross margin line immediately at the register. And management actually noted on the call that the adoption rate of the loyalty program was much faster than they expected.
So they are basically a victim of their own success here. Too many people downloaded the app and claimed their free goodies at once.
In a strict financial sense for the quarter, yes. It pressured the margins heavily in Q4, and it will continue to pressure them in Q1.
Wow.
They are essentially investing in future foot traffic by taking a deliberate hit on current profitability.
It's a calculated risk.
They are betting that if they give you a discount today, you'll become that high-engaged, loyal shopper tomorrow. But right now, on the balance sheet, it's just a pure cost.
However, reading through the transcript, there is a really bright spot in the margin story.
There is.
And it involves something very industrial and behind the scenes. Meat.
The Meat Self-Distribution Initiative.
Yeah.
It sounds incredibly boring to talk about logistics, but this is the kind of operational plumbing that actually saves companies.
Explain to us why moving boxes of meat around differently matters so much to the bottom line.
Well, previously, Sprouts relied heavily on third-party distributors to get their steaks and chicken from the farms to the stores.
The middleman.
Right. Now, 75% of Sprouts stores get their fresh meat directly from Sprouts' own distribution centers.
That's a huge shift.
And they have a massive new facility in Northern California coming online early in Q2 to complete that rollout.
So what is the actual benefit of moving that entirely in-house? Is it just about cutting out the middleman's fee?
That is part of it, sure. But the much bigger benefit is control. Capital C, control.
Control over what?
When you control the distribution trucks, you control the freshness. You get much better stock levels. And most importantly, you have less spoilage.
Which is what they call shrink.
Exactly. Shrink. That is the industry term for basically stuff we threw away or stuff that got stolen.
Correct. And in fresh meat, spoilage is a massive, massive cost center. If the steak sits on a third-party truck too long or gets routed inefficiently, it expires. You have to throw it in the dumpster.
Pure loss.
By controlling the supply chain end to end, they drastically reduce that waste. And eventually, they get long-term cost protection against freight inflation.
It's a huge efficiency play.
It is the shield that is protecting them from even worse margin erosion right now. Honestly, if they didn't have this meat distribution coming online, that 38% gross margin might be looking a lot worse today.
So, to summarize the operational side, they are taking some deliberate pain right now with the loyalty program costs, and they are taking situational pain from the sales drop. Yep. But the supply chain work they've done over the last 2 years is acting as a structural buffer.
Exactly. It's the adult in the room strategy. You fix the underlying plumbing of the business, even if the house party upstairs is starting to quiet down a bit.
Let's move to the third segment of our deep dive, the pivot to affordability.
This was fascinating.
It was a major theme on the call. Honestly, it feels like every single retailer is saying this exact same thing right now.
It was inescapable on the earnings call. The CEO basically said, look, customers love the store, the net promoter scores are incredibly high.
Right.
But they are screaming about price.
The sticker shock is real.
It is. Affordability and access are the new required buzzwords coming out of the C-suite.
This feels like a massive tension point for them, though, right?
How so?
Well, Sprouts is fundamentally a premium store. It is designed as a treasure hunt. It is where you go specifically for organic, grass-fed, artisanal, small batch stuff.
Right. Can they really pivot to being affordable without completely destroying their brand equity? I mean, let's be real. You don't go to Sprouts to save money. You go there because you don't want to eat the processed stuff at the discount store.
And that right there is the multi-billion-dollar question for management.
Yeah.
They absolutely cannot win a price war with Walmart or Aldi. They know that.
Impossible.
If they try to sell conventional Coke and Tide at rock-bottom prices to drive foot traffic, they die. Their underlying cost structure simply does not support that model.
But they aren't selling Coke and Tide.
Exactly. So what is the strategy? How do they make a $12 jar of artisanal almond butter feel affordable to a stressed consumer?
How do they do it?
It is all about practical value. Management talked extensively about specific psychological price points.
Okay, give me an example.
$5 sandwiches at the deli. Wellness bowls for under $10.
Ah, the $5 sandwich. That is a classic retail hook. It's just like Costco with the $1.50 hot dog.
It is exactly like that.
Sprouts has the sandwich.
It gets you in the door for lunch on a Tuesday. And here is the retail psychology behind it. While you are standing there waiting for your cheap sandwich to be made, what do?
You browse, maybe grab a drink.
Right. You grab a $6 bag of organic chips or a $4 probiotic soda.
The margin is in the add-ons.
It is entirely about creating the perception of value so the customer doesn't feel like they're getting ripped off, even if the grass-fed steak in the back is still super expensive.
Right.
If I can get a really healthy, fresh lunch for $5, I subconsciously forgive the higher price of the produce a little bit.
That makes sense. And they are using the loyalty program as a weapon here too, right?
Very much so.
It connects right back to the margin hit we discussed earlier.
This is the really smart play. Instead of slashing prices across the entire store, what we call carpet bombing discounts, which just immediately kills your overall margins, you use the loyalty data.
So it's targeted.
Very targeted. You send a personal discount specifically to the customer who hasn't visited in 3 weeks.
Right.
You give a coupon for fresh berries, strictly to the person who usually buys yogurt, to get them to buy both. It is surgical discounting.
So if I suddenly stop buying their expensive chicken, the algorithm notices that gap in my basket and sends me a 20% off chicken coupon to win me back.
Exactly. They bring you back to the meat counter without having to lower the price of chicken for everyone else in the store who is perfectly willing to pay full price anyway.
That is brilliant. It optimizes the margin per shopper.
It sounds like they're trying to tightly thread a needle here.
Keep the core health enthusiasts happy with my end products, but don't scare them away with massive inflation on their weekly staples.
And honestly, they have to do this. Management basically admitted on the call that they got a little too premium over the last couple of years during the inflation boom.
They pushed it too far.
They drifted way too far up the pricing ladder because people were willing to pay it. Now the consumer is exhausted, and they have to come back down a rung or two to meet the consumer where they actually are today.
Let's transition and talk about the actual stuff they sell on those shelves. Segment 4, innovation and foraging.
I love this part of their business.
I love that they call their sourcing team foragers.
It's great branding.
It sounds like they have people out in the woods looking for rare berries to bring back to the store.
It fits the whole crunchy aesthetic perfectly, and this is their actual economic moat.
Right.
Like we said, they aren't selling the same stuff as Kroger or Safeway. If you want regular Oreos, you go to Kroger.
If you want grain-free, monk fruit sweetened paleo cookies, you go to Sprouts.
Exactly. What were the specific product trends they highlighted on the call? Because honestly, Sprouts is usually a very strong leading indicator for what is about to get popular in the mainstream in like 2 years.
This is where it gets culturally really interesting. They leaned incredibly heavily into the no seed oils trend.
Oh, that is huge right now. You can't open social media without seeing it.
It is a massive, almost militant movement in the wellness sphere.
People are actively, aggressively avoiding canola oil, soybean oil, sunflower oil.
They believe it causes systemic inflammation.
Right. And whether the underlying nutritional science is totally settled on that or not doesn't actually matter for the stock.
The consumer has settled it.
The consumer has decided seed oils are toxic. And Sprouts is leaning all the way into that shift. They are aggressively stocking and highlighting products specifically marketed as seed oil free.
What else did the foragers find?
Gut health and longevity.
Longevity is the new buzzword.
Products that focus strictly on outcomes. It's no longer just this tastes good. It is this will actively help you live longer and optimize your biome.
Right.
In regenerative farming, they specifically mentioned a whole line called Elevate Organics.
Oh, and I heard them mention a brand called Tractor Beverages.
Yes, Tractor. They called it a modern haymaker.
A modern haymaker.
It's a functional hydration beverage.
Yeah.
Clean ingredients. This is exactly the kind of stuff you only find at Sprouts first.
And the private label?
They also mentioned that the Sprouts private label brand, their in-house stuff, is now doing over $2 billion in sales annually.
$2 billion. That is 26% market penetration within their own stores.
That is massive. More than $1 in $4 spent at a register in Sprouts is spent on their own brand.
And that is incredibly high margin revenue.
That is exactly why the vendors desperately want to be there.
Management made a point of that, didn't they?
They claimed that emerging brands actively want to be in Sprouts because it is the ultimate launchpad.
It's the incubator.
It is where you find that wealthy, niche health customer before you try to scale up and go mass market.
Right. If you are a small startup brand, you can't afford the millions in slotting fees to get on the shelf at Walmart.
But you can get discovered by a forager and put on an end cap at Sprouts.
So the product mix is incredibly strong. The innovation is clearly there, but the overall foot traffic is the near-term issue.
That's the disconnect.
Let's look at the investor context.
Yeah.
If you are listening to this and you are holding this stock and you see the negative comps coming in Q1, what is your safety net? Why shouldn't you just hit sell tomorrow morning?
The safety net is made of cold, hard cash.
The best kind of net.
Specifically, share repurchases.
They announced a new authorization, right?
A very big one. A brand new $1 billion share repurchase authorization.
For a company of this specific size, $1 billion is a lot of firepower.
It's huge.
Yeah.
Their total market cap isn't that massive in the grand scheme of things.
And they have the cash flow to support it.
Their full year 2025 operating cash flow was incredibly strong. It was $716 million.
Wow.
And they actually bought back $472 million in stock last year alone.
So even if the underlying grocery business slows down, they are actively engineering EPS support from the finance department.
Exactly. This is what we call the buyback floor.
Walk us through the math on that.
Let's do the simple math. Earnings per share is simply your net income divided by your total shares outstanding.
Right.
If your net income stays completely flat, let's say because sales are sluggish and margins are tight, but you actively reduce the number of shares outstanding by 5% or 8% by buying them and retiring them,
Your EPS still goes up.
your EPS still goes up, even if the business itself didn't grow a single inch. It artificially, but legally, puts a floor under the stock price.
Right.
If the stock drops hard next week because of the bad Q1 guidance, the company itself just steps into the market and buys more of its own shares at a steep discount.
It's basically like management is standing there saying, look, if you guys don't want our stock at this price, fine, we will take it.
Precisely. It projects massive confidence.
And what about physical growth? Are they still opening new stores? Or are they hunkering down and hoarding cash?
They are definitely still expanding. The roadmap for 2026 includes opening 40-plus new store locations.
40 new stores, that's aggressive.
They are entering entirely new geographic markets. They specifically mentioned a pipeline building out in the Midwest and the Northeast.
Okay, so they certainly aren't retreating.
No. They clearly view this Q1 slowdown as a temporary speed bump, not a dead end.
The second half repair thesis?
Right. Their whole thesis is that after a rough first half of 2026, a few things will happen.
The loyalty program data will finally kick in and drive traffic.
Yes. And the year-over-year comparisons will get much easier. Remember, by Q3, they won't be lapping that King Soopers strike anymore.
The math gets easier.
The math normalizes, the loyalty investments mature, and the ship stabilizes.
So let's clearly summarize the bear case versus the bull case for the listeners before we get to our trade idea.
Okay, the bear case is very simple.
Pitch it to me.
The COVID and inflation boom for premium groceries is permanently over. 2025 was peak earnings for this cycle.
Okay.
The low-engaged tourist customer is gone and is never coming back because the economy is tighter.
Makes sense.
The margins are going to steadily erode as they are forced to fight for foot traffic with aggressive discounts. In short, if you buy now, you are catching a falling knife.
That is a solid bear case. And the bull case?
The bull case is that the health enthusiast core demographic is incredibly sticky.
Right.
These people aren't going to suddenly go back to eating conventional Cheetos and drinking high fructose corn syrup just to save $20 a week.
Yeah. They are ideologically committed to the food.
Exactly. Furthermore, the massive billion-dollar buyback protects your downside risk as an investor.
And the operational stuff.
Right. The supply chain work, specifically the meat distribution centers, will yield massive long-term margin benefits once those upfront loyalty program costs finally normalize.
So you just have to hold your nose and survive the first 6 months of 2026.
Exactly. Hold through the turbulence, wait for the second half stabilization.
Okay. That is the fundamental breakdown. We have completely dissected the earnings, the guidance, the operations, and the strategy.
We covered it all.
Now, it is time for the segment where we throw the sensible textbook out the window. It is time for This Is Not Financial Advice.
Disclaimer. We are absolutely not financial advisors.
Do not listen to us.
We are literally just two voices in your headphones discussing market mechanics. This is for entertainment purposes only.
If you trade real money based on the segment, you are entirely on your own.
Please consult a professional.
All right, all that said,
Yeah.
What is the pitch today?
I am calling this trade the seed oil spread.
The seed oil spread, I like the ring of that.
Or, if you want to get a little more Wall Street fancy with it, the purity arb.
Okay, I am listening. What is the setup here?
The setup is based on the massive cultural shift we just talked about in the foraging segment.
Right.
Sprouts is going all in on no seed oils, regenerative farming, and gut health.
Which we establish as a very real trend.
It isn't just a grocery preference anymore. This is becoming a full-blown cult-like movement.
It really is.
You have fitness influencers, massive podcasters, celebrities. Everyone is suddenly talking about avoiding processed industrial sludge.
Okay, so how do we actually trade a cultural vibe?
You execute a pairs trade.
Yeah.
You go long SFM. You buy Sprouts.
Okay.
And you go short a legacy, highly processed food giant.
Like who?
Let's say HRL, Hormel Foods.
Yeah.
Or even just short a generic CPG ETF that holds all the big traditional center of the store packaged brands.
Walk me through the exact logic here.
You are financially betting on the rise of the orthorexic consumer.
The person who is obsessed with healthy eating.
The person who treats the grocery store perimeter exactly like a pharmacy.
Right.
But here is the massive macroeconomic kicker that makes this trade work. GLP-1 drugs.
Oh, wow. Ozempic, Wegovy.
We can't do a deep dive on food retail without mentioning them.
It's the elephant in the room.
Exactly. As these weight loss drugs proliferate across the population, people are fundamentally eating less total volume of food.
Because their appetite is chemically suppressed.
Right. When you eat significantly less volume, psychological shifts happen. You want to make sure what you do eat is incredibly high quality.
You want maximum nutrient density per bite.
Sprouts wins entirely on nutrient density. Legacy processed food companies rely entirely on high volume consumption.
That is a fascinating angle.
If I am only eating 1,500 calories a day because the drug completely kills my appetite, I am not wasting those precious calories on a can of Spam or a box of processed crackers.
Right.
I am going to buy the grass-fed steak and the organic blueberries.
That is actually terrifyingly plausible. It's a quality over quantity play, but it's being driven by mass pharmacology.
Exactly. And here is the twist that makes the trade safe.
There's a safety net.
You pair this macro thesis with a lullaby long.
Explain that.
You go long on Sprouts stock solely because you know the buyback support is there. Management has $1 billion in cash ready to spend. If the Sprouts stock drops temporarily because of the bad Q1 guidance we talked about, the company immediately becomes the biggest buyer in the market, propping your long position up.
So you are effectively front-running the company's own treasury department.
Exactly. You rely on the gut biome gamble for the massive upside if people shift diets, and you rely on the buyback floor for the absolute safety.
It is the perfect hedge fund pod trade.
Long the cult, short the sludge, protected by the corporate checkbook.
I love it. Again, listeners, do not do this. Do not trade this. But I love the mechanics of it.
It is a very compelling narrative to watch play out, if nothing else.
All right, let's wrap this up. Give us the final recap for you guys listening.
To sum it all up, Sprouts delivered a very solid 2025, beating expectations in Q4.
Yep.
But 2026 is starting with a serious hangover. Q1 comps are projected to be negative due to the loss of those tourist shoppers and lapping a competitor's strike.
Margins are tight.
Margins are tight due to deleverage and heavy loyalty program rollout costs. However, the balance sheet is an absolute fortress, and they are buying back stock aggressively to support the price.
So the takeaway is to watch for the stabilization in the second half of the year. That is the key metric.
Right.
If they can demonstrably turn the ship around by Q3, this current dip in the stock might actually be the golden opportunity.
But for now, you should expect some chop. The tourists have left the building, and Sprouts has to focus on re-engaging the locals.
Which leaves me with one final kind of provocative thought before we sign off.
Lay it on me.
We talked a lot about Sprouts being the ultimate middleman for these niche, highly engaged, orthorexic health consumers.
Right, the forgers bringing the goods to the store.
But what happens when that specific consumer who is incredibly online, researching every ingredient, listening to longevity podcasts, decides they don't even need Sprouts anymore?
What do you mean?
Think about it. With the rise of direct-to-consumer regenerative meat boxes, local farm-to-table subscriptions, and specialty brands selling directly on social media, does the hyper-optimized health consumer eventually bypass the physical grocery store entirely?
An ultimate disintermediation.
Exactly. If you only eat grass-fed beef and raw honey, you can just buy that straight from the rancher online now. If Sprouts loses the tourists to Walmart and eventually loses the zealots to the internet, where does that leave their ceiling?
That is a structural risk nobody's pricing in right now. Something to definitely chew on.
Something to mull over. Thanks for joining us on this deep dive.
Keep watching the take.
See you next time.